and 10 seconds for Facebook.
All right, it looks like we're live. Hello and welcome everyone, wherever you are on the four corners of the earth. We are glad that you are here today with us. I am Mary Bell Carlson and I am joined today with Ryan Law. We are both excited to spend some time talking about the American Rescue Act, which just passed last week. And we are going to explain it specifically in the light for financial counselors and coaches, but anyone can learn from it. We're glad you're here today. All right. We are also, just FYI, we are live both on Facebook. So welcome to our Facebookers. And then also welcome to those who are live on our webinar. And we appreciate all the effort behind this support that AFCPE has given to make this possible today for that great AFCPE team. So thank you all there. As I mentioned, I'm Dr. Mary Bell Carlson. I am the CEO of Chief Financial Mom. I have a fun blog that is written for moms, about moms, to help moms and their personal finances. I also have spent the last year with Rebecca Wiggins. Many of you have heard me on the podcast, Real Money, Real Experts. And we've just had a great time interviewing people about financial coaching and counseling, and it's just been a really great time. So welcome today. I am an adjunct professor for the University of Georgia and Texas Tech, is how I spend my daytime hours. And then I've also spent several years in federal and state government relations positions here in DC. So I've done everything from a county government clear up to federal. And that's why I love this legislative side. It's really, really interesting to me. Ryan is here joining us in Utah. He's out of Utah. I'm out of Virginia. So we're covering pretty much the entire side of the US here. And Ryan has recently, if you've not been to Ryan's website in the last couple of weeks, he has a big change that he has announced. He is now helping financial professionals learn to improve their client communication. He started off his business as a student loan expert, still continues to be that, but is really working now to help connect the expertise, the expert with an expert. So more of a B2B, business to business type approach, and really excited about what he is producing out. So keep in mind, drop by his website, stay up to date on his social media. He will be dropping 2 blog posts a week, and I greatly admire that. That is a Herculean effort if you've been a blogger before. Ryan also daylights, not moonlights, but daylights to Utah Valley University. He is their director of the Money Management Resource Center. He has spent decades in this area and has been a huge help. He's written a couple of books and is really knowledgeable. He has also been our 2021 AFCP past president. He was last year's president and did amazing things during a very pandemic year, very interesting year. So thank you to Ryan for joining me today. All right, so let me start off by telling you a little bit of what was now known as the American Rescue Act of 2021. And I'm going to go into politics a little bit. For those of you that don't know, AFCPE is a nonprofit, nonpartisan organization. So I want to state that up front. I am not talking politics in an AFCPE sense, but I'm giving you some of the history and the background of how and why this bill passed. So as we like to call in the government relations world, it's like making sausage and you really don't want to see how it's made. You just want to enjoy the benefits of it thereafter. So we're going to talk a little bit about that sausage today, though, and I'll give you some background for those of you that are interested in the politics behind it all. This is the largest so far. It's a 1.9 trillion, and I said trillion with a T, economic stimulus. It is a ginormous ongoing COVID-19 pandemic. It's helping fiscally shore up some of the resources that were started in last year. There's obviously, we're still concerned about a recession and some angles, there's a lot of people that are still hurting. And so this is meant to meet some of those needs. This started as a House, most of the time on the appropriation side, this is a House created initial version of the bill that was a partisan pass for the most part, with the Democrats holding a slight lead, not huge, but a slight lead over in the House, passed on to the Senate. And I've put on here something really important. The Senate passed this on a 50-49 vote. There was only one senator that abstained because they were at a funeral. And it was actually, and I have this written down, so excuse my turn over here, but it was actually Senator Sullivan, who's a Republican from Arkansas, was at a funeral and was not able to vote on that bill. So it was a very split vote. And for most of you would know, even if it was a 50-50 vote, you know who the tiebreaker would be? It's the vice president. So either way, even if that Republican senator had been there to vote, and let's just presume they voted along with their party colleagues, it would have still been passed, but it would have been passed by the vice president. That's the way the Senate works. But here's a key part that you need to know behind this. It was not passed in the typical way that most legislation is able to pass through the Senate. And the reason why is there's this thing called filibuster in the Senate. And in order to have cloture in the Senate, you have to have 60 votes or more to prevent a filibuster. As you can tell, they were not going to get that 60 votes, right? And so what they did instead was turn this into a reconciliation bill. With a reconciliation bill, it's things like appropriations and taxes and spending. You cannot put in other things outside of that. It has to maintain within those, and it can pass on a simple majority vote. So that is really important to note, because there is one provision that has been talked about a lot in the news, and even from this administration that came out and said, we want a $15 minimum wage provision. That was cut from the Senate, and here's why. The Senate parliamentarian, which acts like the Senate police, they essentially look at it and say, this does not fit within a reconciliation bill, the guidelines and the law requiring reconciliation. Therefore, that minimum wage provision was cut from this bill. It is not a part of this act and will have to be dealt with later on. The other reason I wanted to talk to you about this, and let me kind of finish up how it all came about. It goes, after it barely passed the Senate, it goes back to the House. They again passed the Senate version, and eventually it was signed into law by the president on March 11th. Now, let me tell you some interesting politics behind the scene, though, because this is also going to predict what's going to happen in the future. We are in terms of, when I say we, both the House and the Senate are very, very tight and split, as many of you know. And with that, that means one senator, and in this case, the senator that had a lot of power on this particular bill was Senator Joe Manchin from West Virginia. He is a conservative Democrat, but he came back in and he said, hey, I am not going to vote on this particular piece of legislation. It's actually having to deal with the unemployment. And he said, I'm not going to vote on that. He actually voted with Senator Porter's, who is a Republican, his read of that particular segment of the bill. And so it sent the Democrats scrambling to come up with a compromise that they were able to more moderate. And eventually he signed on with Senator Wyden, who is out of Oregon, and that is how it passed. What that is saying is that any one senator, and you're looking at a lot of the very moderate Republicans and very moderate Democrats, they are going to be the ones holding the most power in the Senate at this time, because every single vote is going to count in this. And as you can see on this vote, one person on either side switching makes a huge difference. Just so you know, there are a couple of independents. The independents most of the time are voting with the Democrats. So those independents could hold some power in there as well. So just keep that in mind, because that is also going to predict, we've got a Biden tax reform that is coming down the pike that possibly could pass, but we know that nothing in this, because of the strong split, nothing is going to be passed in a completely one side or the other. It's going to be how really Congress was set up, to duke it out, to fight it out, and to come back with more of a moderate approach. Now, I am not saying by any means any Republican in here would shoot me and say this is not moderated. I get that. But it is they are having to go back and delegate. And I think that example with Joe Manchin from West Virginia shows exactly how delicate every single vote is and how much sway every senator has on that. So just to kind of give you some background there, not to talk politics, but to give you more. Okay, go ahead, Ryan. These are the areas, I put this up there because when you're talking about a $1.9 trillion bill, this bill itself was 242 pages long, not the largest ever, but a significant bill. These are all of the areas that are eligible for funding. And right now, even at the state, local level, they are certainly parceling out what cut they get. There's still a lot of unanswered questions from this. So by no means are we trying to cover everything on the slide today. I just want to show you the behemoth that this bill actually is. When we're talking in the trillions, this is a giant of a bill, or I should say act now that it is written into law. And so we're just going to touch the parts that matter the most to financial counselors and coaches, and probably most consumers, the things that are going to trickle down immediately for you. Go ahead, Ryan. Yeah, I know. I knew someone was going to catch me on those airlines. Yes, I can't even say it. Lufthansa is not receiving American money. It's just the clip art that I happened to find. So thank you, someone, for catching me on that. All right, so let's talk about the big elephant in the room that everyone has cared about. If you've searched Google over the last year, probably the #1 search thing over the last 2020, 2021 has been stimulus checks. Everyone wants to know when they're getting their stimulus checks. So these are the largest stimulus checks that you have seen. They are $1,400 a person. And there's some significant changes in this versus the CARES Act and versus the legislation that came out last December, more than just money. And let me clarify here, because this is going to be very important for you and your clients, is it qualifies now for all taxpayers and all dependents. As you know, all of the 2020 legislation that went through, if you had a high school senior who happened to be 17 or 18 years old, or you had a college student who is still your dependent, and we're keeping in mind, all of these are dependents, when you had those come through, or you took care of an elderly parent, they were not considered dependents. I shouldn't say they weren't considered dependents. You were not given money for their care. So this is the first time that we are seeing stimulus checks for those older high school seniors usually, and any dependent college kids that are still left on the parents, or any for elderly parents as well. So this is a big deal to a lot of people who had not received any money for their dependents in 2020. So this is what it means. It's not limited to that under age of 17. The only thing here is they have to be a dependent on your tax return in order to receive that check. That is great news for people who are caregivers. And keep going, Ryan, you're good. So let me give you a few examples, because I know there's going to be a lot of questions around this. So here's 3 examples, and this hopefully kind of encompasses a broad umbrella. So we're talking about a single taxpayer with 1 dependent, okay? And I don't care if that dependent is a single mom with a child like you see in the picture here, or someone taking care of an elderly parent. It doesn't matter the age, or even a parent with a kid in college, right? In that case, it's a single taxpayer, 1 dependent. That's 2 people times 1,400. They're going to receive $2,800. That would be the same if, let's say, Ryan was taking care of his elderly mother, and it was just the 2 of them. He would receive the same amount of money I would if I were a single mom taking care of my infant child, okay? The second example that I want to give you, and this is where a lot will fall in, is a married filing jointly to taxpayer. So we're talking about 2 taxpayers in this situation with 2 dependents, or 15 dependents. If you have 15 children, and by the way, this was not included in a lot of the 2020, it had a limit on the number of children you could claim as dependents. That is not true in this version of the act. That this one, it is regardless. If you have 15 children and I know that's an extreme example, but if you have all of them as dependents, you receive 17 times 2. In this case, we're saying the picture here is 2 taxpayers, 2 dependents. The rebate in this case would be 4 times 1,400 is $5,600. Honestly, if you have 9 kids, we have friends that have 9 kids and they have 2 taxpayers, they're going to receive about $15,000. It's significant for larger families. So that does make a difference and is different from what it was last year. The third example I'm going to give you, let me go back real quick. Oh, it's right here on the 7. So I give you kind of a picturesque example here. So let's say in that case, it's like they've got young children, they've got kids in college, and they're taking care of elderly parents. It covers all of that, right? So it just depends on the number of dependents you're claiming on the tax return. All right, thanks, Ryan. The difference this year too are these lovely things called AGI limits, right? Adjusted gross income is what that stands for. And this is going to be based on a couple of things. It's your 2019 tax return, which at this point, most tax filers have filed a 2019. Or if you've been like ahead of the curve, it's going to go off your 2020. It's whatever is the most recent tax return you have on file. We're going to talk about some planning techniques I can give you in just a second. But this is going to be based off one of these two returns, depending on which one you have on file as of today, or whenever that check is cut. Some of you probably have already received that money. So if you are in order to get a full payout, so the entire $1,400, if you were a single filer, you need to earn less than $75,000, head of households $112,500, or married filing jointly only $150,000. Now, depending on what part of the country you live in, that could be a median salary in your area or quite a lot. But this is federal again. So it is not, there's no COLA attached. It doesn't matter if you live in New York City or if you live in Manhattan, Kansas, which I love. But there is a big difference between the Manhattan, Kansas and the Manhattan, New York, right? But it doesn't matter where you earn that. These are going to be the phase outs. The other thing is the ranges. So remember the phase out, it starts here and then it cuts off at the top of that range. But let me tell you a little bit right now, this is not really a range. When you're talking about a $5,000 or a $10,000 band, this is what we call a cliff, meaning it goes straight down and there's very, very little room for concern or discretion here, right? And so what happened last year is most of what we saw, and let's talk married filing jointly for a second. So the bottom end of that range, the 150,000, was similar to the number we saw last year, but the top end was 200,000 last year. Now you're only seeing a $10,000 band for married filing jointly. That means if you earned $161,000 or even $160,001 in AGI, you received nothing in return. And it also makes that band, the bands are much tighter in range. So let's say you receive $151,000. Before it was only $5 per 1,000. So you had a lot of $5 increments to lose. This one, you lose a lot more quickly. So just keep that in mind. On the single side, it's only a $5,000 range. So literally, if you make $1 over that on those AGI side, you will not receive this check. It has to be under these AGI phase out ranges. Go ahead. Okay, because I know I'm getting lots of questions and I had a lot of questions myself. So let me give you 3 checkpoints that you need to think through when helping yourself or clients with this question of, will I get a check? Okay, the 3 checkpoints, and we'll start with number 1, is did you file a 2019 return, which most will say yes, and therefore they're going to go off that most recent return filed. So if it's 2020, and you were a single filer and you made let's say $85,000, they're going to go off your 2020, not the 2019 where you made $73,000. And talk to a tax expert, but there's not a good way to claw that back and try to get the money and then resubmit it. If you want to try that route, I'd definitely suggest a tax expert. But they're going to go off the most recent return filed, and your income has to be equal to or less than that phase out range, and therefore you get the full check. So if you are good at checkpoint 1, yes, you will receive a rebate check. And if you only have 2019 income and your 2020 income, most people it went down, but some it actually went up in 2020, you may want to slow walk that 2020 return until you get the money. So the IRS is not going to come back. Let's say you file in May of this year. Now the new date is May 17th instead of April 15th. And if you were to file that return in May 17th, but you already had your check, the IRS is not going to come back to you and say, hey, give us our $1,400 back, right? If you qualified at checkpoint 1 as of now, then you get the full amount regardless of what your 2020 return happened. Okay, so let's go to checkpoint 2. If you have not filed your 2020 return, but a lot of people, their income went down in 2020. And so if your 2019 income is higher than your 2020, your 2019 income might take you out of the running, but your 2020 income is lower than the threshold. You might get a partial check. And so in this case, let's say that you have, let's go back to like a Ford dependent. You would not receive a full check if you made $155,000 in 2019, okay? You would receive a partial check. But then if you made, let's say 145,000 married filing jointly in 2020, then that means you will get a check, but you're going to get two checks this time. So the first check is going to come sooner rather than later, but it's only going to be a partial amount. And then if you file by what we're calling an additional payment determination date, which is now August 17th, since that has been moved to May 17th, it's 90 days after the change in date, or September 1st. So it turned out to be August 17th. You have to file before that date your 2020 taxes. Now, big implication here. You business owners who typically wait till September 15th filing deadline, really bad idea this year. Because if you wait till August 18th, you will get nothing back. You have to file before this date if your 2020 income is less than your 2019 in order to get that second check. And that's called a recovery. Rebate is recalculated, and then they send that back out. And we keep using check. I'm going to talk about different ways IRS, but you get my point. You get my drift there. Okay, so if you're good at one, if you're not good at one, but you're good at two, you're going to get your full check. Now let's talk about, you didn't hit one, you didn't hit two. Let's talk about number three. And this one is very unique because you do get a recovery rebate tax credit in 2021. So this is where the planning part comes in a little bit. If your 2021 AGI is less than either your 2019 or your 2020, and you're going to be below the phase out. So think here, if I'm going to make more, or if I make less, or if I could make less in 2021, then I could actually get a rebate down the road when I file my 2021 taxes and apply it to my 2021 as a tax credit. So this is where you could have some tax planning opportunities for you and your clients, and that's good to think through. Go ahead and switch to the next slide, Ryan. If you want to know right now, if you get a 2021 recovery rebate payment, this is the link to go to. You sign in, you put in your social, you put in, it is the IRS website, you put in your date of birth, and it says, I will cut you a check, or here's the date it was sent. Some of you have already sent it in your bank account, but if you're wondering, don't call your bank, don't call your accountant. They're plenty snowed under. Just go find out for yourself right here. Go ahead and turn the page, Ryan. So let's talk about a few planning ideas for this 2021 recovery rebate. And before I start this, I do want to emphasize, I am not a tax or accountant. I am not a lawyer. And so please, before giving this advice to any client, make sure that you are speaking, or for yourself, that you speak to the appropriate individual. But very generally speaking, here's some very broad ideas. Could you lower your income in 2020 compared to 2019? Or I'm sorry, let me try this again. If your income in 2020 is less than 2019, you want to get that thing filed. I keep saying that, but I can't emphasize it enough. It's super important you hit that deadline this year, or you will not. I mean, think about the family with several kids, right? You're talking possibly tens of thousands of dollars in significant amounts for many people. If and I gave this example already, if you had more income in 2020 than you did 2019, slow walk that return, still get it in on time, but slow walk that return or extend it so that you are getting that refund back. This is, by the way, and this is really where I'm going to point you to a tax expert, but 2021 could be the year for married filing separately. Usually we always say this is never a good idea. Well, there's always the always and the nevers, right? Nothing is always or never. These are one of those very unique situations that it could be a good idea to file married filing separately. If you have a client, I would highly, highly, highly recommend that you go to a tax professional with this and they run some numbers for you, because there's a lot of things that you will miss out on married filing separately, but the credit is actually significant enough that it could make up for anything that you're losing there. And then, of course, there's some additional time off, and these are good things to talk with your accountant or a lawyer about, but it'd be extended vacations. Maybe you're a small business owner and want to make extra retirement contributions, some ways to get that income back into those ranges if you're on the border or you're close. Go ahead, Ryan, and switch that out. All right, I did want to cover real quickly the first and the second pandemic payments. So the first one was clear back last April, if you can remember that far back when you were doing the same thing on your couch that you were doing in December. You'll want to go back. If you still are wondering what that is, you can file a rebate credit if you did not get it. And let me use a personal example. I had a baby in November of 2020. So I did not get money for her back. This sounds awful, but she did not get a rebate check or credit back in April or in December, right? She wasn't born in April, but she would have been eligible for the December payment. And so what we did on our 2020 taxes is she gets that rebate credit on the tax, the 2020 taxes that we're about to put in. So you can file a credit on those, but you have to file a 2020 tax return. Even if you don't usually have to, in order to get this credit, you do have to file the return in order to get it. Again, those lovely tax accountants will help you more with that. One more, Ryan. Oh, and then it's off to you. I will answer any other questions that you have in a minute.
Yeah, I was gonna say, we have do you want me to ask questions now or save them? We have a few that are specific to the stimulus payments.
Ryan, what would you prefer?
I think where there's stimulus payments, let's go ahead and take a couple of them.
Okay, all the ones that are related to dependents, just really quickly.
Okay.
A lot of people want to know, if somebody dies in 2020, do they still get a check in 2021?
Good question. In terms of the 2021, and Ryan, I'm going out on a venture here, but my understanding, if they died in 2020, they are not going to get this under the 2021 tax credit. Now, the question becomes, if they literally pass away within the last 2 weeks from the time this was signed into law, or even the last week, I guess, from the time this was signed into law to now, if they pass away within the last week, that would be definitely something to consider. And you're going to have to ask an accountant. There will be more details coming out on that. But if they passed away in 2020, this was not signed into law until March 11th of 2021. So it would not, unfortunately.
Okay. For divorced parents, if one parent, does it depend who claimed them to who gets the stimulus check for the dependent?
The person who, so it's whatever parent gets to claim the children as dependent. You have to claim them on your taxes in order to get the benefit. So it's whichever parent is the tax credit. So if you alternate every other year, it's going to be whatever parent gets them this year on 2021 taxes.
We have a question about if you have an adult dependent, does that mean the adult dependent does not get the check themselves? And I'm going to go ahead and say that's yes.
Right. And so the key in that, that's a good question, Summer, because the key in that is dependent. So if you have, in our situation, we have a adult who is on disability, but they are not a dependent of us. In our situation, that adult still is independent for tax purposes. Therefore, they still get that check. And by the way, that is true for people on Social Security. It's true for people on disability or any kind of other government programs. They are still receiving these checks. Good question.
Okay. We have a few that are very specific taxes. I'm just gonna let you guys know, I'm not going to be passing those questions on.
Yeah.
But I will ask this one. People are being born all the time. How does the birth date affect this check?
Oh, good. Okay. Well, I'll give you, I just told you my example. So in my daughter's case, yeah, she was being born in November. So she does not get the April check because she was not born in April, but she got the December one. We were able to file that on our 2020 tax returns. Again, all of this is predicated by when this was signed into law. And that would be true for both the death as well as the birth. And if you have very specific, I would check with the tax accountant if you're kind of in a bracket somewhere in there that you're kind of wondering. But by far and large, if the person was born or had died by that date, if they were born, they get the check. If they had died, they wouldn't get the check. That's a rule of thumb. Ryan, go ahead.
Yeah, I thought that it was their whatever they were on December 31st. So like, I think when you file your 2020 taxes, you may get that April check because by December 31st, your daughter would have been born. So I
True.
thought it was the date by the end of the year. I could be wrong on that. Again, check with I'm not an accountant either. I'm also not a lawyer, regardless of my last name. So check with your accountant, but I'm pretty sure that it's their whatever age they are on December 31st.
Thank you. And that's why we do this as a team, folks, because
Yes.
Ryan makes up whatever half I don't get. Okay, Ryan, I think it's time to turn it over to you.
Okay. Awesome. Yeah. So the stimulus payments, huge portion of this, but the child tax credit is another big one that could make a real difference for a lot of people when it comes to filing their taxes and what that's going to look like for next year. It's important to note right up front, this is a 1-year change on the child tax credit. We'll talk more about that as we get into this, but right now, this is a 1-year change. So these are the 5 areas that we're going to go over. And just this is the only slide I'm going to have about age. So in the past, the child tax credit has always been for those 16 and under, which always threw me off because as kids get older, they get more expensive. So I never understood why they cut off the child tax credit, just as your insurance is about to double for your car insurance and all these different things. But regardless, this 1 year, they have changed it. And for that, I am really grateful because my oldest daughter turned 17 this year. So it's going to work out very well for us. So as long as they are 17 or under on December 31st of 2021, then you will get this child tax credit. So we'll go through all of these other bullet points here or slides here. If I can get this to advance. There we go. All right. So what is the credit? First of all, in 2017, it's important to recognize that this doubled. It was $1,000 and it doubled to $2,000 in 2017. So just within the last 4 years, this child tax credit has significantly increased. Only a portion of that was refundable, which we'll talk more about here in just a minute. But just again, understand that this child tax credit, it was $600 when it was first introduced, and now we're up quite a bit higher than that. So if you have a child between ages 0 and 5, as long as they are 5 or less on December 31st of this year, your new child tax credit for them is $3,600. If you've got a child who is 6 through 17, again, December 31st is the cutoff date for that, their rebate is $3,000. Again, it's one of those things that you look at and say, yeah, I've got diapers and maybe some more expensive daycare and things, but I can tell you from experience that as my kids have gotten older, they're definitely more expensive, but that's the way the law was passed. So again, $3,600 is your child tax credit for 0 through 5, $3,000 for ages 6 through 17. So what that means though, is if you are due January 1st and you have a baby on January 1st, they will not qualify for a tax credit this year. So they need to be born by December 31st, 2021 in order to qualify for that. Okay, there's a couple of cutoffs for this child tax credit. And the thing that makes it a little more confusing is that there's 2 separate cutoffs. So this is for the initial $2,000, just the regular child tax credit that's in place. You can see that the ranges are pretty big here. To get the full credit, if you're filing single head of household or a married filing separately, you're at $200,000. Double that for married filing jointly, you're at $400,000. So as long as you make $400,000 or less, if you're married, you are getting the full initial $2,000. It does start to drop down after that. And then you can see the upper ranges here where it drops all the way to 0. So we're at $240,000 and then $440,000 for married filing jointly. So again, that's for the initial $2,000. But as you know, from the last slide, there's an additional $1,000 or $1,600 available. And that has a different threshold. And again, this is where your accountant or tax professional is really going to come in handy because they're going to be able to help you through this next year. So you can see the ranges here. You've got single at 75, head of household at 112,500, and then married filing jointly at 150. And then there's 2 different ranges. If you've got a child, let's just say married filing jointly, that's my situation. If for my children that are between 6 and 17, it cuts off at 170. For my child who's 4, it cuts off at 182, because what happens is every $1,000 increment you make over that amount, it drops by $50. So you can see there's a lot of moving parts here. I don't want to get too deep into the taxes here, but you can see there's a lot of moving parts in order to get the first full $2,000 and then the additional $1,000 or $1,600 for those children. Okay, let's talk about what it means to be refundable. So when the Tax Cuts and Job Act was passed in 2017, they made $1,400 of that child tax credit, that $2,000, they made that refundable, which means that you can actually get back more than you paid in taxes. So you can have well, I'll go through an example here in just a minute. So 100% of this new one though is refundable. The entire $3,000, the entire $3,600 is fully refundable. So again, that means you can get back more than you actually paid in. So here's our example. Somebody is married filing jointly. They've got 3 children, ages 3, 7, and 12. So we know that their total child tax credit is going to be $9,600 because you've got $3,000 for the 7-year-old, $3,000 for the 12-year-old, $3,600 for the 3-year-old. If they've got a tax burden at the end of the year of $2,000, excuse me, this child tax credit can actually take it below 0, where they get so they're in this situation, disregarding everything else, they're going to get a $7,600 refund. Any questions on that before I move on? I want to make sure that people understand this. Okay. All right, so here's another thing that's happening this year. So these are going to be paid out in monthly checks, that child tax credit. So 50% of the amount that you're going to be getting in child tax credit is going to be paid out between July and December of 2021. It's supposed to be monthly checks. We'll talk about that more in just a second. So if you've got a 0 to 5-year-old, you should be getting a check. And again, it's direct deposit for most people, but for some people, it will be a check. $300 for 0 through 5, $250 a month for 6 through 17. And then when you file your 2021 tax return, you're going to get the other 50% at that point. So the IRS they've got to set up a website, and you're supposed to be able to log in there. Sorry, my voice is just cutting out here, Mary.
I can jump in, Ryan, when you need to. So Ryan is really the expert on the child tax credit. Having said that, we don't want him to lose his voice here. But I can skip forward, Ryan, if you want, to unemployment until you get your voice back on that.
Let's give it another shot. Okay, I think I'm okay. So, all right. So again, in order to send out these checks, the IRS has been instructed to set up a website, and there is doubt from them as to whether or not they can actually do that. So on that website, you're supposed to be able to update your info, change your income, your family size, your marital status, and you should be able to opt out of those monthly checks. Because the problem with this is if your income goes up in 2021, they will claw back part of this child tax credit that they paid out monthly. So if you know that your income is going to be going up significantly in 2021, and you're going to be over those thresholds, you may choose, once that website is available, to log in and just opt out of those checks, just to make sure that you're going to be in good shape when it comes to filing those taxes in 2021. All right, let's talk about child poverty for just a minute, because this is the big news that's coming out of this, and another portion I'll cover in a few minutes, which is the earned income tax credit, is what is this doing for poverty? So first of all, it is cutting the remaining number of children in poverty by more than 40%. That is a significant thing that is happening where it's pulling those people out of above the poverty limits. And so that it also effectively eliminates deep poverty. So deep poverty, I believe that the number for that is you're less than 50% of below the poverty line. And so it is effectively eliminating that because of those checks that are going to be coming every single month. They're saying that's going to lift approximately 4.1 million children above the poverty line, which again is significant. And you can see that a large portion of those are people of color, underrepresented groups. So 1.2 million Black children will be lifted out of poverty, and 1.7 million Latino children are going to be lifted out of poverty as a result of this. I also read something that said that children in rural areas are about in that same amount, where they've got these deep poverty areas where so many of these children are now going to be lifted out of poverty, which is amazing. So let's look at what this is going to do on the average American family. And I realize nobody is average, but we're going to go ahead and go off the median income of $68,703. So just almost $69,000. And we'll say they've got 2 children. So they're married filing jointly, 2 children, ages 8 and 11. So if you take their AGI 68,703 or their income minus the standard deduction, they've got an income of almost $44,000. Because of that, they've got a tax burden of $4,873. Again, we're going to disregard every other credit, whatever they've paid in the past, and just deal with this one credit. So if they've got a tax burden of $4,873 and they've got a child tax credit of $6,000, again, that is fully refundable. The entire thing is refundable. So they are actually going to get a refund of $1,127. So again, this is going to have a significant impact. If this was last year where only 1,400 of that was refundable per child, it's not going to be nearly as large of a refund for them. So this is going to make a significant difference, again, especially for these larger families. I mean, I've got 5 children. One is under the age of 4, or he's 4, and then I've got 4 others who are up through 17. So for a larger family like mine, it's going to have a significant impact on our taxes for 2021. And with that, Mary, we'll go back to you, unless actually we'll see if there's questions about that.
I have just one question. Does everyone need to sign up in the IRS website for the monthly child tax credit deposit, or is it done automatically once you file your 2020 taxes?
Yeah, good question. It's supposed to be done automatically, but again, there's a lot of questions as to whether or not, even the IRS has said, we have no clue how we're going to build this system and how the IRS has been, they've had to work really hard to figure things out over the last year to get all these checks out and to get these direct deposits done. So they said that they are going to work on it, and their goal is to have it done by July. But they said I read an interview where they said, look, if it's August or September, we'll just make sure you still get the full 50% by December 31st. So, but you should not have to sign up. It should be done automatically. You want to keep up with that if that's going to pertain to you, which it will pertain to most people. So keep up with that. Check on that website when it comes out. We'll try to update things as well as we get more information. So keep an eye out for that.
Okay, a couple more just came in really quickly, hopefully.
Okay.
What happens if somebody turns 18 in 2021?
Yeah, so the cutoff is 17 by December 31st of 2021. So if my daughter was turning 18 this year, then she would be off. But because she turned 17 and she will be 17 on December 31st, then we qualify for the child tax credit for her.
Okay, and then just to confirm, the $3,600 child tax credit is for which tax return?
That is for your 2021 tax return. So it's this year right now. And again, this only applies to this year. This will probably be made permanent. That's one of the things that the Democrats are talking about, that they want to make sure that this child tax credit becomes permanent. But this is for 2021. So when you file these taxes in April of 2022, that's when you'll get the other 50%. Or if you opted out of the checks, you'll get the full 100% at that point.
I'm going to jump in and get going on the unemployment, and we'll finish out the presentation and then use whatever remaining time we have left to answer any further questions. So right now, there are almost 10 million Americans that are currently unemployed right now. And we see, I had this question before we started on state by state. Keep in mind, unemployment benefits typically are a state by state benefit. For example, in Massachusetts, it's about $1,000 a month. Whereas in the deep South, states like Mississippi, it's like $300 a month. So lots of this depends on your state. And we're only going to be talking at a federal level here. So here's what happened with the American Rescue Act. Benefits were going to expire March 14th. And if you remember hearing quite often, the deadline for this specific bill to be signed was March 14th. And this is why. Because if that had not been done, the extra benefits would have expired. It is now extended to September 6th, so we can anticipate that something will happen between now. More than likely, it'll be late August and very early September before Congress acts. They usually do it right before. But what happened in this one is you get an additional $300 in income from the federal government, plus whatever the states gives you. So if you're in Massachusetts and you're getting $1,000 a month, it'll be $1,300 a month. Whereas if you're in Mississippi, it's literally going to double your amount in Mississippi, because it goes from $300 now to $600. So again, it just depends on the state you live in, but the federal government is going to fund an additional $300 for every unemployed individual. It is tax-free compensation up to $10,200 dollars per person. A couple of catches on this is you have to have married, family, jointly, or I'm sorry, for all tax statuses, it's 150,000 or less. And this is a true cliff. So this means absolutely $1 over, you don't get that tax benefit on that. Can you go ahead and switch on to the next? Three things that I want to mention about pandemic unemployment, go ahead and hit all three of them up, is one, you have to figure out your eligibility in your individual state. This varies state to state. So go to your state's Department of Labor office, figure out what the ruling is for your specific state. And this is true, I'm speaking as if you were talking to a client too. True for whatever state the client lives in, not where you, the help giver, live in. It's where your client lives that you need to find out. And then what they have to file through the state's Department of Labor office. You also can apply for benefits over the phone or online. And Ryan, I'm going to ask you this really quick. It really is not the state you live in, it's the state you work in, correct?
That's correct, yes.
So let me stand corrected on that. It is where you work, not necessarily where you live. But it would be that state where you work that you need to file through. Go ahead and switch to the next one there. Now, going along in tandem with this unemployment are these healthcare updates. So the key catch on these healthcare, this is a great benefit for someone who has been involuntarily terminated. So if you quit your job in 2020 or currently, you do not get this benefit. But if you were involuntarily terminated, COBRA coverage, that is the long name for your extended healthcare, is really what it stands for. So you get the healthcare from your previous job. You have extended it now through the end of April. And if you've ever lost a job before, you know this can be a really expensive option, but for a lot of people, that's the only coverage they have, unless you want to go to some of the state plans. So the cool part about this, or it depends on how you're looking at, but for someone who doesn't have health insurance that was just that was terminated, they can actually get their COBRA coverage at no cost. The government is subsidizing that at 100%, but they have to elect to do it within a 90-day window. So you'll want to make sure and watch those dates carefully. Again, reaching out to that state unemployment office or watching for updates on that is going to be key. A couple of keynotes. Again, you cannot have quit. It is also not Medicare eligible, or you cannot have a secondary insurance. So if in my case, if we use my insurance primarily, but my husband also had a secondary insurance, it would not cover if I were terminated. We would then go on his insurance instead. So you cannot have any other group health plans available for this to be cut, but a huge benefit for those who were afraid of losing their healthcare coverage while also losing their job. Ryan.
Okay, so I'm just going to cover these briefly as well. I've got 2 points I'm going to cover here. So first is the enhancement of the earned income tax credit. This is only enhanced for childless workers. So it does not apply if you've got children. This only changes for those who do not have children. So previously those who didn't have children, it was limited to ages 25 through 64 to qualify for the earned income tax credit. They are changing that now. So it's ages 19 through 24 qualify. It also eliminates that upper age limit. So before, if you were 65 and made low income, and had no children, no dependents at home, you would not get any of the earned income tax credit. That has been eliminated now with this act that has gone in. However, and this was a huge oversight, I think, on the part of this, they left out full-time students. So if you would have qualified for the earned income tax credit, but you're going at least half time is how the bill was written. So they said at least half time, then you qualify for no EITC unless you have children. Again, that changes everything. We are only talking about childless workers here. So what it does is it increases the income at which the maximum credit can be reached. So more people are going to qualify for this now. And it also cuts off that, it increases that upper limit. So that just like a lot of other tax credit, this one phases out the more income that you make. So before as long as you made 4220, then you got the maximum, but when you hit 5280, it was cut off. That is now raised to 9820, and the upper limit is 11,610. So but also the credit the maximum you could get prior to this year was 543. That is being increased to 1502. And again, this is going to come when you file your taxes for this year. So nothing is going to change during the course of 2021. It is going to be when you file your taxes for the 2021 tax year that this tax credit is going to go into place. Couple of notes on that. Just like I mentioned this before, this is going to help about 17 million childless workers who are pushed to or below the poverty line. We'll run through a very quick example so you can see what that looks like, but 2.8 million Black families, 2.8 million Latinos, 678,000 Asian American workers, all of them are going to be pushed above the poverty line because of this. They say that the top occupations that are going to benefit are our cashiers, our food preparers, servers, home health aides. Those are the main occupations that are going to be lifted as a result of this enhancement of this earned income tax credit. So let me just do one quick example so you can see how this might work for somebody. Single 25-year-old, no children in the house. If they work 30 hours a week, they're making about $13,700 per year. They're just barely above that poverty line. They're a few $100s above that. What happens though, as you know, 7.65% of their paycheck is being withheld for Social Security and Medicare. So they are still paying taxes. A lot of people say, oh, they don't pay any taxes, but they definitely do. They're paying $1,048 in taxes right there. So they're also going to owe a little bit of tax money at the end of the year. $130 is what they're going to owe. So their net taxes is $1,178. Under the current EITC, they would have gotten back $160. Their net taxes were still over $1,000, putting them actually below that poverty line. So their net income as a result of those taxes pulls them below the poverty line. The idea behind this is we want to not pull people below that poverty line. So with the new EITC, these people would get over $1,000. Their total taxes for the year would be $62. And their net income is now again above that poverty line, just barely they're above that, but they are still above that poverty line. So that is what that earned income tax credit enhancement is going to do. And then just one slide here about tax-free student loan relief. Any student loans that are forgiven in 2021 through 2025 is going to be income tax free. So that doesn't, we're not talking about public service loan forgiveness here. We're talking about those income-based repayment plans. However, and it's all federal and private. So any loan, any student loan that is forgiven 2021 through 2025 is going to be income tax free. There's going to be a few of those people who are on the income contingent repayment and have been for 20 years almost, who are going to have forgiveness under this. So it's not really about that. It's about this. It's about setting up forgiveness tax-free. So President Biden has said that he wants to sign $10,000 tax-free for all student loan borrowers. This act put the mechanism in place where it would be tax-free as long as it's done before 2025. That $10,000, if that goes through and actually happens, 10, 20, whatever the amount is going to be income tax-free. And that brings us to the end. So we've got a few helpful resources here about student loans, about small businesses, because there is additional Paycheck Protection Program money in here. There's additional money for restaurants. There's additional money for bars, different places like that. So those these will be on the slide deck when those are sent out. And with that, we have about 6 minutes left. So Mary and I will take questions.
So really quickly, before we do the questions, for anybody who is certified through AFCPE or is an AFC candidate, the AFCPE completion code for this is ARA for American Rescue Act 2021. That is ARA 2021. Capitalization doesn't matter, but spaces do. No spaces. ARA 2021. Okay, first question. Do you know how people will get their COBRA refunded?
Their COBRA, this will be from now going forward. So refunded from here back, you'll need to check with it again. It's from here going forward, right, Ryan?
Yeah, and it's only if what I read about it, and it was just a brief paragraph or two that I read. I think it's only like April through September of this year.
Mm-hmm.
It's for just 2 quarters. And basically your employer still pays it, but they get a tax credit. So that's how it's working. So you won't actually pay it. It will be at zero for you. Your employer pays it. They get a tax credit for it. That's how the COBRA is working. But again, it's a pretty short, it's like 2 quarters out of this year is all.
And so keeping in mind, it won't go through your taxes. It will all be paid to the employer just to keep that alive and going.
Yeah.
That's great.
We have a couple of questions about entering the completion code. Please just visit my.afcp.org. If you have any questions, you can give us a call at 614-368-1055. So just to confirm, because this has come up a couple of times, everything we've talked about today is from this point forward. None of it applies to 2020. It's all about 2021.
Yeah.
For the most part, yes.
For the most part. Yeah. I mean, everything like the stimulus checks are all based on 2021. Earned income tax credit, child tax credit, that's all 2021. And things that are, as I mentioned, things like the child tax credit, the goal of the Democrats is to make that permanent. They want to expand that out because of the effect that it's having on poverty is really the reason for that. So I would anticipate sometime later this year, we're going to see a vote come up on several of these provisions, one of those being the child tax credit.
I do want to jump in there though, Ryan. I don't think that this is a definite shoe-in, and I will go back to that 50-50 split that we were talking about at the beginning. So there are a lot of Republican senators that have gone on social media explaining how they were opposed to this. So do not think that it is going to fly in its current format. We're not going to see things rubber stamped through. And again, everything that's going to be passed that is very partisan in this is going to have to be a reconciliation side of things. So it's going to be very difficult to get through. And keeping in mind, those conservative Republicans and conservative Democrats are going to have a lot of sway, because one vote, one way or the other, could really either get something slid along or not. So just keep that in mind. Even though one side may want it, it's so tight right now that we're seeing it pretty close. I've seen a little bit of that on the chat. So I just wanted to make sure that everyone knew that as well.
What about military living overseas? How do they file unemployment? Does this even apply to them?
If you're talking about a military spouse, the end of military individual would not apply to. If you're talking about the military spouse, I'd actually have them reach out to Military One Source on their tax side and get an expert on that to help them with that side of it.
Yeah.
If you're with the military overseas, then you have a job. Unemployment's only going to affect those that don't.
Okay, we have a question about forgiveness for past student loans. My understanding is the taxes are forgiven for forgiven loans, but not the loans themselves, correct?
Right. So basically what they're looking at though, is they're looking at eliminating $10,000 worth of student loan debt for everyone out there. So if you've got $15,000 worth of student loan debt, and whether it's through executive order or through a bill, if President Biden signs something that says $10,000 is wiped out, your new balance is $5,000. The tax-free forgiveness would be on that $10,000 that's forgiven, where you would not owe taxes on that. Because typically if you have your student loans forgiven through like income-based repayment or pay as you earn or revised pay as you earn, you're going to owe taxes on that amount. And there's been a lot of senators saying, hey, let's eliminate the taxes that they're going to owe. We've already made interest off of these students. We've already taken money, origination fees off the front end. So let's eliminate at least the taxes that they're going to owe if any amount is forgiven. So that's what we're looking at here.
This one may be too specific. COBRA, does that apply to the military, or is it TRICARE continue as long as you are honorably discharged?
The latter. TRICARE. So again, if COBRA is usually a private workplace type setup or something through there. If you're military, you're TRICARE. If you're dishonorably discharged, you're going to have to go that through JAG. I don't have a clue on dishonorable discharge, but yeah, everything through military would be applicable to TRICARE and whatever situation they have set up for that.
And we've had this question in various forms. What if a stimulus check payment is sent in error? So for example, for a child who is 17 but turns 18 before the end of the year, do they have to pay that back, or is it like last time where they're just like, well, whatever, we're not going to?
So that's a really good example. Okay, so for this specific check, it does not matter if they're 17 or 18. So there is no error on that side. So let's use an example. If you had a child that was your dependent in 2019, but they became independent in 2020, and the latest tax records the IRS has on file as of today, as they are cutting checks, is the 2019, then you are going to get that check for that 18-year-old or 19-year-old yourself. It will not go to them until they file those taxes. So keep in mind, if you maybe hit checkpoint number 1, but you didn't hit checkpoint 2 or 3, you still hit checkpoint number one. You're good to go. You get your check. They aren't going to, there's no callback on this. It would be a very unique situation for them to come back and say, give us the 1,400 back. If you hit any one of those 3 checkpoints, you get to keep the money, even if your income was low in 2019 and then raised in 2020, or low in 2020, raised in 2021, you keep the money.
The only area where you may see that callback or clawback is on the child tax credit. As I mentioned, if your income goes up in 2021 and you're over those thresholds for the additional amount, you probably want to consider going onto that website once it's available and opting out of the monthly checks, because a certain portion of that could have to be repaid on your taxes. So I would, again, talk to your accountant, but I would in most cases recommend that if you foresee going over those amounts, that you eliminate those monthly checks and just take whatever credit you get when your taxes are due.
I'm
Yep,
muted.
2 separate things, Sarah. Go ahead.
So really quickly, if you guys don't mind staying for 5 or 6 more minutes, we have a few more questions.
I'm good.
One is, I think someone asked, if something is really fully refundable for taxes, the tax credit, they're not getting refunded full following their filing. That's completely incorrect. If it's fully refundable, you get the full amount back, even if you don't owe those taxes.
Correct.
So why is the IRS paying the child tax credit monthly payments? I'm pretty sure that's to help families rather than waiting for a giant refund at the end of the year.
Right, because right now, I mentioned I've got 5 children, so that's a significant child tax credit that we're going to have in the year. So they're saying, instead of getting it all in April of next year, let's just go ahead and pay part of it out now, because that will help families out right now. Because getting a big check, that doesn't help people in poverty. A monthly check is going to help them more, and that's what they're looking at. I'm not saying we're in poverty, but it's going to help those families who are in poverty. If they've got 3 or 4 children and you're getting a check of $1,000 a month, that changes things for a lot of families. So that's the reason for that.
Ryan, can I have one? I see one here that says, should we encourage students not to pay up to $10,000 of their student debt through 2025? I think this is a separate issue, right? That has not been passed. Do you want to talk about that a little bit? The Biden forgiveness?
Yeah, for sure. So it's something that the Democrats have wanted, and they talked a lot about in the early debates. Biden talked about 10,000. Elizabeth Warren and others talked about 50,000. Biden has said he does not support $50,000 of elimination, but he does support up to $10,000 of forgiveness. However, they're talking about limiting that to a certain income limit. So we're going to see that, but nothing has happened there. So it's all conjecture right now as to whether or not there's going to be student loan forgiveness. We don't know if it's going to be 2,000, 10,000, 12. We just don't know. But what they're saying, according to what Biden would like, though, he wants to forgive $10,000 of student loan debt. But I wouldn't encourage somebody not to pay. I mean, right now you're off the hook for payments through September. So certainly you don't need to make payments on that right now. But as far as I wouldn't go into default in order to have this potentially forgiven, because who knows what kind of provisions they'll put on that. So keep paying your monthly payments once it comes to October. And then if something happens with the student loan forgiveness, I would anticipate it'll happen before September, just because they want people, that's when the payments will restart, is October 1st. So if payments start October 1st, start making your payments then. Don't skip payments for sure.
Okay. And then, because someone wanted to reiterate, if truly a stimulus check is sent in completely in error and there's no question at all that it's an error, do you have to pay it back? My understanding is actually you did not have to pay it back for the previous checks, and I thought it was the same for this one, but
I mean, an error, like they send an extra 1,400, is that what we're looking at? Like you qualify for 14 and they send 28 or something? Is that?
In this particular case, it was that somebody filed for a child as a dependent 1 year, and the spouse was going to, or the ex was going to file in the next year, but the check was already sent for the first one.
Then what happens in that case is whoever got the check gets to keep the check. There will not be a check coming out to the new spouse. And that has been answered in several ways. I think you're right, Summer. There's been a lot of question. So these errors, it's just going to be whatever tax return they have on file right now is going to be the one that they are going to use. So whoever claimed that person as a dependent will be the one getting that check. And so there is no error on that side. That is just where the check's going to go.
And we're out of questions, which is
All
pretty exciting.
right, we
Thank
answered
you, guys.
everyone's questions.
I think we got them all. If you guys
Thank
ask
you.
questions in the chat, I might have missed it. Sorry, but I think we caught everybody. Thank you guys so much for this webinar. It was incredibly valuable. And thank you all for attending. And I hope you all have a great day.
Thanks,
Thank you,
everybody.
everyone.
Bye.